So what we're going over today, we got some lender updates from Ted Leorakos. Ted's going to explain when buy downs could be better than price reductions. And he's going to actually show you the math on one of our listings. We're going to turn things over to Ted Leorakos. So give Ted a round of applause. Welcome, Ted.
Thank you, Bob.
Thank you for bringing our sweet rolls, as always.
Yeah. Thank you, Bob. Thank you, Mike.
You're welcome.
Good to see you. Okay, so rates are at the lowest point in the last 2 months, but they're not low. They're not low enough to move the needle. I mean, basically, the rates went from average 6.75 to 6.5. So what I want to talk about today is what could possibly move the needle. As we have seen, the market is shifting. We were seeing listing come on Friday, open house Saturday, into escrow Monday for a long time now. Mm-hmm. We're not seeing that. We're seeing multiple open houses, multiple weekends, and properties just aren't selling as fast. Is it because of less demand? No, demand's here. But there's the dude out there needs a place. The demand is here. The problem is affordability. So I want to talk about a buy down, and we're going to use one of your listings as an example. But before I do, let me just share with you the history of a buy down, because it's been a long time since this became a powerful method versus a price reduction. It started with builders. Builders would build phase one at a sales price. They would build phase two, but they couldn't sell them because the market shifted. You drop the price, hell no. You piss everybody off in phase one if you drop the price for the model match.
Good point.
They, along with a very creative savings and loan back just before the S&L crisis, during the S&L crisis, created the buy down loan where they said, okay, look, we cannot drop the price. What we're going to do is we're going to buy down the rate so low that the buyer says, I'll pay that price. And that's what the buy down does. So let's start with the basic. 6.5% interest. The sales price,
Just use the down arrows there and you can
down arrow, right there.
keep going.
Go again.
One more time.
Oh, beautiful. Oh, that's technology. Love it. Okay, so let's start with this price. $1,789,900. Let's assume 20% down. Let's assume 30-year fixed mortgage at 6.5%. That is a $9,000 a month payment.
Ouch.
Okay, $9,078 to be exact. So here's what happens. When you do a buy down, basically what's happening is you are now taking money from the seller's pocket relative to, it's not a price reduction. It's not a price reduction. What you're doing is you're deploying less money than a price deduction. This is why a seller would be amicable to do this. And you're saying, I'm going to do a 3-2-1 buy down. Now, buy down loans are like a box of chocolates. It's a box of chocolate, but there's different types. There is hundreds of different buy down options. Every situation is different. I'm using the basic one that I think works best for a high-priced house like this. So basically what the seller is doing is they're paying for 3.5% as a fixed rate for the buyer for year one, 4.5% for year two, 5.5% for year three, and then it goes to 6.5% year four. Now, bearing in mind, this is a 6.5% 30-year fixed loan with no points. This stays that. The difference is the seller is deploying capital as a credit to buy down the interest rate for the buyer. You with me so far? Here's the difference in payment. Instead of $9,078 per month, which you see at the bottom, they have year one, $6,431. That's their payment year one, principal and interest. No taxes and insurance in this. This is to keep it simple, principal and interest. Year two at 4.5%, $7,268 a month. Year three, $8,148 a month. And then in year four, they go to what they would have if there was no buy down. Here is the temporary savings. when you see year 1 payment versus year 2 payment versus year 3 payment based on 6.5% being the note rate, this shows the annual savings all the way to the right of that column. It also shows at the bottom, when you add it all up, the total buy down cost is $64,650. So that's how much the seller would deploy. Now, here's the really cool part. If your client is going to be faced with considering, and I'm talking about the seller, with, okay, we got to drop the price, $75,000 in order to get somebody to buy this house, that's a better option. And as a real estate agent, I think you guys can agree that keeping the prices stable in the neighborhood, because you don't want to be the one that creates that first step down, where everybody in the neighborhood knows, oh, geez, you just sold the house for $75,000 less than it was listed for. That's kind of a loss, even though it's a win because you got the deal done. This is a way to basically take what the builders created and you're using it to facilitate a sale. Now, the thing that's amazing for a buyer, when a buyer calls and says, hey, Ted, can you explain this? Yes, here's the way you explain it. The seller is deploying the capital to be able to buy this rate down. But here's the really cool part. If rates drop in 2026, or if rates drop in 2027, whatever of those buy down funds that you see, that's the buyer's money. They can use that to actually pay maybe 2 points to buy a 30-year fixed rate, assuming it goes down to say 5.5. They can buy it down to 4.875 using money that the seller gave them in effect in the beginning of the transaction. Does that make any sense?
So it could be a 3-2-1 buy down, or it could be just a total loan buy down. Yeah.
Buy downs can be permanent. Buy downs can be temporary. And the buy down math varies obviously with the market. It also varies based upon the price of the house. This math that I gave you is based on that sales price. If you've got an $800,000 listing, the buy down math that I would present wouldn't be this one. It wouldn't be 3-2-1. It would probably be a 2-1. Because obviously the loan amount determines how much you have to pay in order to get the rate lower. If you have a $3 million listing, then this will work. This will work better. This is the whole point of this, is as a listing agent to have an arrow in your quiver that is in addition or a substitute to a price reduction. And for a buyer, this is powerful. We're doing a lot of these now, and not a lot of lenders, like for example, bank can't do this. They're not allowed because of that rule that nobody can pay that much for a mortgage loan. Banks aren't allowed to do these. You got to be a mortgage broker to do this. I didn't know that. Yes, banks are not going to do buy downs. I mean, they'll do a short-term buy down where you can pay an extra 2 points to buy down the rate for a short period of time, but buyers don't like that. They want to know, okay, rate 6.5, I get it. In years 4, 5, 6, whatever, I'm going to be at 6.5 if rates don't drop. But see, the environment right now is perfect for this type of buy down because everybody is hearing that eventually rates will come down. The idea that inflation is easing and rates will come down make this easier for a loan officer like myself to convince a buyer that they should consider this. And it's an opportunity that wasn't available. We didn't need it.
Because doing this doesn't cause any prepayment penalties.
No.
If the rates drop to 5.5 on year 2, they can refinance it then.
The last slide, maybe it's the last slide. Oh, that is.
They don't have to
Okay, so here's what we do. And I can't speak for all mortgage brokers, but what we will do is we will commit in writing that from the 7th month, because there's always pain and suffering to yours truly if it gets paid off within 6 months. But from the 7th month to the 36th month, we don't charge anything to come back for the prevailing interest rate for a refinance. They have to pay third-party fees. They got to pay you for title. They got to pay for escrow. They have to pay potentially for an appraiser. Sometimes you get a waiver, but if they prepare them to pay for an appraisal. and they're going to pay for a credit report, but they're not going to pay any processing fee. We already have all their stuff. What's the process? Alita's already done all the heavy lifting. All we have to do is say, hey, Alita, pull the file, update a pay stub, update whatever. These buy down loans are powerful because it allows the opportunity to answer your question. When rates drop, you get out of it. There's no prepayment penalty.
Good point.
Yes.
How much did it cost the seller to do that?
$64,000.
So it could be up. You can see.
Yeah. So the buy down cost is $64,650. That's how much the seller would issue as a credit for a buyer to make a full price offer and get the house. That's the builder trick from many years ago that we're going to be
So what it's
using.
showing there, Michelle, is that, see in the top right box, it says years 4 through 30 at 6.5, the payment's $9,078. See that?
Mhm.
If instead there was a $65,000 price reduction, it only drops the payment to $87.25. It only drops the monthly payment a couple $100. But
Okay.
instead of dropping the monthly payment a couple $100, which is not that impressive to the buyer, doing the buy down and dropping their first year's payment to $6,400, the
Yeah,
second year,
that was
that's a much
that's
more
like
impressive.
60 something thousand just with the annual savings. was
Yeah,
that.
and Bob he hit the target right on, because where this was seated was when we started to see price reductions, clients would say, okay, hey, this house I was thinking about just went down $50,000. What does that mean? They were unimpressed with the answer, because a $50,000 price reduction or even a $100,000 price reduction doesn't move the needle that much relative to the monthly payment. Every market cycle has its unique differences. During the S&L crisis, during the meltdown, you had oversupply and less demand. This didn't work because there wasn't anybody really interested in buying the house. That's why the market was dropping. This is an affordability issue. As a loan officer since 1980, and you've got very experienced loan officers that are part of your group, I'm sure we can all agree on the fact that over the years, we have been fighting underwriters to convince them that the borrower can actually afford the payment. Well, here's the shift. We don't fight that anymore. Now we're fighting with the borrowers. I think you can do it. It's not an underwriting thing. It's literally just a comfort level. The demand for housing is higher than it's ever been. I could paper my wall with pre-approval letters, but they won't pull the trigger where they're making low offers. So I don't want to take up too much of your
Any
time.
other questions, guys?
Yeah, you reach out to
Last
me
question,
anytime.
Mike?
Now, just a quick point on this too, guys. So now you're going to take this information and transition it into a marketing brain. So you take this information, if you have a seller that's willing to do this, or if you think you can, if you're representing a buyer and you think you can pitch this to a seller, you've now got to take this and go market your sphere, your clients, your email chain, your text chains, and say, look for those professionals. Guys, there's teachers, police officers, young medical professionals getting into being a doctor in their early years. We know all those salaries graduate every year. And they're going to go from, making this much this year. And sometimes, within 5-6 years, it's going to triple, quadruple. So that's what we go target. And we use this information to show them, hey, we can get you in. Look at how much more comfortable this payment is. As your income goes up, your payment's going to go up, but you're going to be able to sustain it. So you've got to turn this into a marketing angle and use it to go generate leads.
We can tell listing agents, this takes me 5 minutes based on the market to prepare what I just prepared for today. This isn't a deep dive. This is very easy. And it can be presented to a buyer. Hey, we're going to go look at a house, try and sell it just as is. But the point is their rejection is, it's kind of overpriced, or I don't want to pay that much, or my payment's too high. Pitch this. And if the buyer agrees, then
Contact the lender, yeah.
thank you. And the listing agent, because a lot of listing agents just frankly don't know this product even exists.